Hey everyone, it's Mark here, and I've got to be honest with you. After 15 years of following the same investment playbook, I just made some pretty significant changes to my portfolio. The reason? Artificial intelligence. Not because AI is bad, but because I realized I was blindly exposed to something that could go very wrong very quickly. So today, I'm walking you through exactly what I changed and why. Because if you're investing in index funds like most of us are, this probably affects you too. For the last decade and a half, my wealth building strategy has been embarrassingly simple. I throw money into the total stock market index fund and I let it sit. That's it. No stock picking, no market timing, no fancy algorithms. Just boring, reliable index fund investing. And honestly, it's worked like a charm. The average return sits around 10% annually. You're essentially buying a tiny slice of the entire American economy. Some companies go up, some go down, but as a whole, the market grows. I've made millions this way. But here's where it gets scary. When you invest in a standard market cap weighted index fund, which is what most of us do, you're not actually getting equal exposure to 500 companies. You're getting heavily concentrated exposure to 10 of them. Right now, today, 40 cents out of every dollar invested in the S&P 500 goes into just 10 companies. Nvidia, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, and JP Morgan. Nvidia alone captures 7 to 8 cents of every single dollar. This concentration exists because market cap weighted funds automatically give bigger companies bigger pieces. The bigger they get, the more money flows into them, making them even bigger. It's a feedback loop. So what's making these companies so enormous? Well, 9 of those 10? AI. Every single one of them is spending money hand over fist on artificial intelligence infrastructure, AI research, AI applications. And the market is rewarding that spending by pushing their valuations through the roof. But here's the uncomfortable question I started asking myself. What if this is a bubble? Think about it this way. For these companies to justify their current stock prices, they would need to generate roughly $2 trillion in annual revenue combined. That's more than what all of them made in 2024 combined. They're not being valued on what they're earning today. They're being valued on what investors hope they'll earn someday. And yes, companies often get valued on future potential. That's normal. But not when that entire future potential is dependent on one single technology bet. And not when they're financing it with massive amounts of debt. Sam Altman, the CEO of OpenAI, said he's willing to spend $1.4 trillion on AI infrastructure. His company makes somewhere between 13 and 20 billion a year. That's 100 times more spending than revenue. And a lot of this money is hidden in circular flows between these tech giants. Each one funding the other's AI build-outs, inflating valuations in the process. Deutsche Bank did some research that actually scared me. They found that if you took out all the AI-related spending happening right now, the US economy would already be in a recession. AI spending is literally the only thing keeping growth positive. And if that spending slows down, or if investors lose confidence in these AI bets, the entire structure could collapse. That's when I realized I had a problem. I was unknowingly betting 40% of my stock portfolio that AI would be worth what investors currently think it's worth. And I didn't like those odds. So I made 5 changes. Let me walk you through them. Change number 1. I reduced my S&P 500 allocation. I didn't dump it completely. I'm not that contrarian. But I moved a significant portion elsewhere. The reason? Concentration risk. All those eggs in the same tech-dominated basket started keeping me up at night. Some people suggest switching to an equal weight S&P 500 index fund, which sounds perfect on the surface. Instead of 40% concentrated in 10 stocks, you'd get roughly 2% per stock across the entire index. But equal weight funds have a hidden cost. They rebalance constantly, selling winners and buying losers to maintain equal weighting. That constant trading eats into returns through fees and taxes. A market cap weighted fund doesn't need to trade as much. When a stock rises, it just naturally takes up more of the fund. When it falls, it takes up less. It's elegant and cheap. So I stayed with market cap weighted. I just reduced how much I'm putting in. Change number 2. I started investing globally. This is the big one. Here's something nobody talks about. Economic dominance doesn't last forever. In 1900, the UK controlled 24% of the world's stock market. London was the financial capital of the world. If you were investing back then, it would have seemed insane to bet against Britain. But Britain didn't stay on top. Then, in the 1980s and 90s, Japan looked unstoppable. Japanese companies were crushing it in cars, electronics, technology. And then, America bounced back. The only certainty in markets is uncertainty. By investing exclusively in the S&P 500, you're completely missing companies like TSMC from Taiwan, Samsung from Korea, Toyota, ASML, Nestle. These are massive global businesses with real earnings and real growth, excluded purely because their headquarters aren't in the USA. I started investing in a global diversified index fund that holds around 3,700 to 3,800 companies across 45 different countries, developed markets and emerging markets. The US is still the largest holding, which makes sense, but if that changes over the next 20 years, I'm positioned to benefit from that shift rather than be blindsided by it. The fee is tiny too, just 0.19% annually. Change number 3. I'm investing in small and mid-cap AI companies. Here's the thing about technology transitions. The money doesn't always flow to the companies that spend the most on R&D. It flows to the companies that use that technology most efficiently. I'm starting to see a pattern with smaller companies. They're not trying to build the best AI model. That game is already won by the big players, OpenAI, Google, Anthropic. Instead, these smaller companies are letting users choose between different AI models. They're integrating Claude, ChatGPT, Gemini, and letting customers pick. As these models get more similar, price becomes the deciding factor. That creates a commodity market. When a commodity market forms, the profits don't stay with the people who invented the commodity. They flow to the people who use it most efficiently. So instead of betting that Nvidia and Microsoft will dominate AI forever, I'm betting that hundreds of smaller companies will figure out clever ways to make money by plugging into AI cheaply. That's where the real long-term returns might be. Change number 4. I'm buying gold. I know, it sounds old school and boring. But something significant just happened in the financial system. In 2025, gold was reclassified as a Tier 1 asset under Basel III banking regulations. That means banks can now count gold the same way they count cash or US Treasury bonds on their balance sheet. For the first time in nearly 30 years, gold has overtaken US Treasuries as the world's largest foreign reserve asset held by central banks. Why? Because central banks are hedging against currency risk and geopolitical instability. China has been aggressively buying gold. India is buying. Russia is buying. They're all preparing for a world where the US dollar might not be the global reserve currency forever. Bank of America's new guidelines suggest that financial institutions should hold around 30% of their reserves in gold and hard assets. Most currently hold around 20%. That 10% shift in demand is massive, and you can't just print more gold. I'm not betting my whole portfolio on it, but I'm allocating a small strategic position, maybe 5 to 8% of my portfolio. I buy some physical gold that I hold privately, and I also dollar cost average into a gold ETF. It's insurance, and when everyone else who understands what's happening starts buying, prices will probably run up. Change number 5. I'm holding more cash. The smartest investor alive right now is Warren Buffett. Do you know what he's been doing? Accumulating cash. He's sitting on $347 billion in cash and cash equivalents. Why? Because he's a value investor. He only puts money to work when prices make sense. Right now, by his standards, they don't. Holding more cash isn't sexy. It doesn't get mentioned in investment blogs or podcasts, but it's strategically important. First, it's insurance. If life throws you a curveball, you're not forced to sell investments at the worst time. Second, when the market does crash, and it will, you have ammunition to buy at prices that actually make sense. People wait years hoping for market corrections and miss out on massive gains because they had no dry powder. I'm targeting 15 to 20% of my portfolio in cash right now instead of my usual 5%. So here's my strategy moving forward. I'm still putting most of my money into stocks because AI could genuinely drive decades of growth. But I'm not putting all my eggs in one basket anymore. I'm diversifying across global markets, so I'm not dependent on American dominance. I'm investing in smaller companies that will benefit from AI becoming a commodity. I'm hedging with gold because the global financial system is shifting. And I'm holding more cash because opportunity always comes to those who are prepared. Nobody knows what happens next. The market could keep running up. The AI bubble could pop. The dollar could stay strong or lose reserve status. But that's exactly why my strategy isn't about prediction, it's about preparation. I'm positioning myself to benefit if AI drives growth, and I'm protecting myself if it doesn't. The lesson here is simple. Don't blindly follow what worked yesterday. Question your assumptions, look at what's actually happening in the world, and build a portfolio that's resilient enough to handle whatever comes next. If you want me to dive deeper into any of these strategies, especially the gold angle, drop a like and let me know in the comments. If we hit 100,000 likes, I'll make a full breakdown video. And please, subscribe if you're serious about growing your wealth without getting caught off guard by market shifts. Thanks for watching. I'll see you on the next one.